Welcome to the video on how to trade Heiken Ashi candlesticks and stochastic indicator strategy. In this Heiken Ashi trading strategy, we look into low risk trading setup that works really well. I will be taking up 5 case studies across different asset classes to explain the details working of this trading strategy. Now what I'm going to show you here is very simple, and this is something you can start implementing from Monday morning. So let's get started. In this Heiken Ashi trading strategy, stochastic indicator has a big role to play. Stochastic indicator here is mainly used to time trades in the market. For this trading strategy, we are using stochastic indicator with 15,3,3 as parameter, and the time frame for this strategy is daily time frame chart. If you want more entry signals through this strategy, then you can choose 8,3,3 as stochastic indicator parameter. Do remember that with this setting, you will get more trades, but you will also get more whipsaws. I would recommend for you to stick with the default setting for now, and once you understand this concept fully, you can then experiment with different parameters. Standard stochastic indicator and Heiken Ashi candlesticks is available across all platforms, and you won't need any special software for this trading strategy. So let us first understand the type of candlesticks you would need to know in this Heiken Ashi trading strategy. The first marking on the chart that you see here are of wide range demand candles that represent up move in price. The second markings that you see are wide range supply candles. These candles give you a sense of momentum on the downside. The third marking that you see now is that of narrow range supply candles. These candles suggest lack of momentum on the downside, and identifying these candles is the key towards trading this strategy. If possible, take a screenshot of this chart and keep in mind how to identify each candlestick type. In the various case studies ahead, I will show you the importance of identifying candles in this Heiken Ashi strategy. The main purpose of Heiken Ashi candlesticks here is to identify strength of demand and supply while deciding whether to enter the trade in the market. Let us now look at how Heiken Ashi candlesticks and stochastic indicator is usually used to take trades. When Heiken Ashi candlesticks and stochastic is combined together, the most common way to trade is to buy when stochastic indicator moves below 30 and to short when stochastic indicator moves above 70. Now this is a method that is recommended in various sources, and while the basic concept is right, execution of this method has to be very selective. The main reason for this is if you go behind every signal that is generated on the chart, you will face unnecessary drawdowns. In this chart, look at all these instances where stochastic indicator has moved below 30. Had you bought in these regions, you would have faced a lot of whipsaws. Therefore, it is very clear that traditional way of using Heiken Ashi candlesticks and stochastic indicator is not the ideal way. There has to be specific instance when both should be used together to identify low risk trading opportunities. Let me now show you the entire framework for this strategy. So let us now see how to combine both these together. Now do remember that role of Heiken Ashi candlesticks here is to identify right entry conditions. And by right entry conditions, I mean conditions where demand in price is clearly visible. Let me now explain this. Look at this phase in the market where price clearly moves lower. In this phase, wide range Heiken Ashi candlesticks are clearly visible. There is definitely supply visible in this entire phase if you see. When stochastic moves below 30, I would avoid buying in this stock as down move has happened on back of wide range Heiken Ashi candles. This clearly represents presence of strong sellers in the market. Look at this region now. Stochastic indicator is clearly below 30, but I would again refrain from buying here as down move has again happened on back of wide range Heiken Ashi candles. Let us now look at this phase. Stochastic here again moves below 30, but this time around, look at the down move candles in this region. Most of the candles, if you see, are narrow in range and do not represent strong momentum on the downside. Now this is the precise setup that we need to focus upon in this trading strategy. Narrow range candles here represent lack of supply and hence this is a low risk entry opportunity when compared with phase 1 and phase 2. I hope this particular aspect is clear. So let us look at one more example on how to combine these together. In this phase, if you see, stochastic indicator has moved below 30 and price moves lower on back of 4 Heiken Ashi candles. Now out of these 4 candles, there are 2 candles here that are wide in range and represent momentum on the downside. When I spot this on a chart, I refrain from taking the trade. Do note that I don't mind missing out on this entire trading move here, as I'm only focused towards high probability, low risk trading setups. Now in this phase, stochastic indicator again moves below the 30 region. Look at price in this region. Price has again moved lower on back of wide range candles. I would again refrain taking trade in this region due to presence of clear downward momentum. I would use the same reason to reject trades in this region and at this zone. Look at all these candles here. At least 2 candles are clearly visible in both cases where downward momentum is clearly visible. If you look at this phase, I will take up a long trade here as downward momentum is clearly missing. I can just spot one wide range Heiken Ashi candle and that does not represent supply on the downside. So out of these 5 instances that I have discussed, I would only take trade in this instance where condition of demand and stochastic indicator is fulfilled. I hope this overall concept is clear. Before we move forward, let us look at the 3 main rules we need to apply in this Heiken Ashi trading strategy. Rule number 1. When price pullbacks, make sure momentum is absent on the downside. Always measure this with the range of the candle. Rule number 2. Stochastic indicator should be below 30 and preferably both slow and fast stochastic should be below the 30 level. Rule number 3. Always prefer stocks with high relative strength ratings and do check for volumes to analyze the overall trend. Price should also be above the 100 period moving average. Now we have looked at rule number 1 and 2 in detail, and let us take up rule number 3 first, and then we will combine all of this together. I'll also be explaining how to minimize whipsaws towards the end of this video. On this chart, I have plotted the 100-day moving average along with Heiken Ashi candlesticks, relative strength and stochastic indicator. Code for relative strength indicator for tradingview.com is given in the comment section below. When you're looking to trade this Heiken Ashi strategy, make sure you check for relative strength of the stock. For long trades, relative strength line should be clearly moving higher. This represents stock is outperforming the broader market. In this chart, if you see, stochastic indicator moves below 30 in these 5 regions. In the first 4 regions, if you see, pullback has happened on back of narrow range candles, and each region here provides entry opportunity for long trade. Now look at all these candles here. All candles are narrow range candles while the pullback is happening. In this 5th region here, I would avoid taking the trade as price has moved lower on back of wide range Heiken Ashi candles. Once price moves below the 100 period average, look at how frequently stochastic indicator starts moving below the 30 mark. This clearly signifies the trend has weakened and long trades should be avoided. So let us now look into instances when you have to avoid trading this strategy. In the previous slides, I mentioned that when pullback is on back of high momentum candles, then avoid taking long trades based on this strategy. One more instance where you should avoid taking trades is when price is clearly below the 100-day moving average. Now we are using the 100 period average here as a trend reference indicator, and hence when price is above the 100 period average, focus on taking long trades only. When price is below the 100 period average, only focus on taking short trades. In this particular case, you are aligning with the trend and you are measuring the direction of trend by using a simple 100-day moving average. In this chart, I will avoid taking long trades in this region and at this point because of 2 main reasons. Number 1, Down move in both these cases have happened on back of wide range Heiken Ashi candles, and in both these instances, price decisively is below the 100-day period average. I hope this point is clear. Now in this region of the chart, I will be open to taking long trades as pullback has happened on back of narrow range candles and stochastic is clearly below the 30 mark. Before deciding on taking a trade, always account for momentum in form of wide range candles and account for price trend. This way, you will ensure that you're on the right side of the trend at all times. So let us now move to specific case study to understand this trading strategy better. In this case study, I have taken up AT&T stock as an example that is traded in the US stock market. In the cases ahead, I have taken up currencies, commodities, and index futures to show application of this concept across all asset classes. In this chart, if you see, price clearly traded below the 100-day average till this particular point. During the same period, relative strength line clearly suggested that AT&T was underperforming the broader market. Price then moves above the 100-day period average at this point, and stochastic indicator moves below the 30 zone in these regions that I have marked. If you look at all these regions, long entry trade cannot be taken as price has clearly retraced on back of wide range Heiken Ashi candles. This clearly represents strong momentum on the downside and presence of strong sellers in the market. For a long entry in the stock, make sure price is above the 100-day average or is in a structure of higher high and higher low. Along with this, stochastic indicator needs to be below the 30 region on back of narrow range candles. Momentum on the downside has to be lower as this would be a clear sign of low supply in the market. Do keep this important point in mind. This case study is of American Express stock that again trades in the US market. In this chart, stochastic moves below the 30 zone in these specific regions. Now out of these regions, long entry can only be considered in these two regions where price is clearly above the 100-day period average. In both these instances, price retracement has happened on back of narrow range candles. This clearly reflects low momentum on the downside. Do take a look at relative strength line as well. As price moved higher from January 2019, relative strength line has steadily moved higher. This means stock has outperformed the broader market. Do note here that we are looking for low risk combination of price retracement along with signs of less supply on the downside. This combination actually works really well and you should explore this further on a daily time frame chart. You can try this on a 60-minute time frame as well, but I would first recommend for you to start with daily time frame. Along with this combination, you also need to check for volumes, and I will explain this towards the end of this video. Let us now look at gold as a case study. Now this is a complex case and hence do pay attention. In this chart, price is moving above and below the 100 period average and stochastic indicator moves below 30 in these regions that I've marked on the chart. Out of all these instances, entry can be taken only in this instance as price has moved lower on back of narrow range candles. If you look at price here, it is not above the 100 period average, and yet if you find this on the chart, you can still go ahead and take a long trade here. Now the reason why long trade is taken here despite price being below the 100 period average is because a structure of higher high and higher low is clearly evident in this region. Do note that if price is below the 100-day average and you still find structure of higher high and higher low being in place, you can still attempt a trade. But do remember that position size for that trade has to be very small. Now in this fourth case, let us take a look at Grasim Industries stock that trades in our market. In this chart, stochastic indicator moves below the 30 region in these four instances. Based on the rules discussed in this trading strategy, long entry would be only available at first two instances. In these two instances, retracement has happened on back of narrow range candles. This clearly reflects lack of momentum on the downside, and hence this becomes our ideal range to enter the stock. In the last two instances, if you see, retracement has happened on back of wide range Heiken Ashi candles. This clearly reflects high momentum on the downside and presence of strong sellers in the market. Now, once you spot this on a chart, avoid taking long trade in these regions. Do remember that by not taking trades, you will miss out on some opportunities as price will still head higher. But as a trader, at all times you have to focus on low risk trading opportunities. This has to remain your number one rule in trading. In this fifth case, we look into USD INR currency pair to understand this Heiken Ashi trading strategy further. Price in this chart is above the 100 period average and stochastic indicator moves below the 30 region in these two phases. Both these phases are marked here where price retraces as stochastic indicator gradually moves below the 30 zone. In both these phases, I will be open to taking long trades as only one wide range Heiken Ashi candle is visible on the downside. Now, as a trader, you should be fine with one wide range Heiken Ashi counter trend candle, but if you spot more than one wide range candle, then avoid taking the trade. Now, as you are starting with this strategy, prefer only those charts where you have no wide range candles present. And as you gain more experience, you can then opt for charts with one or even two wide range candles present on the chart. So let me now explain how you need to minimize whipsaws in this Heiken Ashi strategy. The first rule you have to look out for is the retracement criteria. You have to make sure that price retracement happens on back of narrow range candles. When I backtested this strategy, I found that retracement on back of narrow range candle was an excellent filter to minimize whipsaws and maximize average profit per trade. The second rule you need to track is the impact of volumes on the chart. Make sure that retracement happens on back of low volumes. This would clearly reflect absence of strong sellers in the market. If you can also spot rise in volumes in the direction of trend, then this would be one more factor to consider. Now, as far as stock selection goes, for this trading strategy, you can shortlist both high beta and low beta stocks. Now, do remember that the important aspect here is to identify low risk entry opportunities. You will miss some of the opportunities in wake of this, but do not get distracted. At all times, your aim needs to be on preserving capital while focusing on your money management rules. Now, do watch the previous 4 parts on Heiken Ashi candlesticks, as I have covered many concepts in great depth across various time frames. Link to all these parts will come up at top right end of your screen. In the meantime, if there is any doubt, do let me know in the comment section below as I reply to each and every comment. So kindly consider hitting the like button and sharing this video if you find it useful. Thanks a lot for watching this video, guys. Take care and be safe.